All right, welcome everybody to our Lunch and Learn. Phil Atwan with 1031 Exchange Resources is going to cover everything that we need to know about exchanging and buying properties. So, Phil, it's all yours.
Well, good morning and good afternoon, everybody. I want to make sure everybody can hear me first of all. Can I get a yes or a no on that?
Yeah, we hear you.
Okay, good. Well, it's a pleasure to be with you this afternoon. I don't know why my picture keeps freezing on me. I know I have plenty of power here with internet speed, so I have no idea what the problem is. So I'll just put this dummy picture of myself up.
And yeah, sometimes it's easier with the video off or Zoom, and then it usually corrects itself.
Great. What I'll do is let me start this PowerPoint workshop for you and get things going. And I'm sorry, there it is, PowerPoint, advanced, short version. Let me start with this one. This one will work good. So I will get my screen share up with you in just a second. It would have been up, but I was having problems communicating with the server for some reason. There we go. Okay. So I'll go back.
And the end of your share, just select the right frame. Yeah, there you go.
Okay. So let me do screen share. And I will do this one. And you should have my screen up now, correct?
Yep, I see it.
Okay, good. You think after a year we'd figure it out, right?
Every time it's a new adventure.
Yeah, for sure. Anyway, feel free to stop and ask questions if you'd like to during the workshop here. I'm happy to answer any of your questions and talk about what's happening in the 1031 exchange market. I'm not going to speak about the exchange market, but I want to talk about what's looming in the future for capital gains taxes, for depreciation recapture taxes, for the 1031 exchange itself. I was on a webinar this morning with our association, the Federation of Exchange Accommodators, and we're kind of updating us as to what the climate is now with the new proposed tax bills coming out of Washington, how that's going to affect all this. And I'll be happy to share that with you as we go to the appropriate screen where I can interject what is appropriate for that particular screen. So anyway, let's start from the beginning. Why are there so many people in the South Bay, in Los Angeles County, and throughout the Southland just clamoring to real estate? Well, it isn't just recent, folks. It's been going on like that for decades and decades. Investors buy property because they want to generate, number one, more than anything else, monthly income. Monthly income is going to be broken down into two separate areas: rate of return and cash flow. And a couple of slides coming up, I'm going to bring those up to you. We'll discern the difference. Rate of return and cash flow is the best way to communicate with you because you're talking about both those issues as it relates to monthly income. But if you stop anybody on the street who owns rental properties, they'll tell you the number one reason why they buy them is income. It's very simple. You want a paycheck every month? In real estate, you close an escrow every month, right? Well, do you want a rent check every month? Then you have a single family or a condominium or a commercial single tenant building. If you want a paycheck not once a month, but once a week, so 4 times a month, then ultimately what you do is a fourplex. You get 4 condos or 4 single families or whatever. If you want to get a paycheck every day, you have to have 30 properties or 30 doors that pay you rent. This is why investors buy what you sell: investment, residential, and even commercial real estate. Secondly, they still want to see the investment grow in time. What's the biggest regret people had ago or now? They have regret that they didn't buy 10 years ago or a couple of years ago. I mean, mine is as you go back in time, over decade and decade, we always see highs. But overall, even when it hits, it goes up and surpasses what it was previously. Appreciation over time produces equity. Now, think about if you have money in your 401k or your retirement program, and part of it is in the stock market or in mutual funds. That's what you want. You want it to appreciate, to be worth more, value of the stock to go up, or the mutual fund to go up. Well, the same is true with real estate, but the biggest difference with real estate is, with real estate, not only are you getting great appreciation, you're getting something every month called income. You don't do that in the stock market. That's why with real estate, it's the best of both worlds. Number three, the beautiful thing to an investor is to have tax write-offs, specifically known as depreciation. What's the purpose of it? To reduce the income taxes they pay off the rents they collect. That's really the purpose of having a tax write-off, because the government wants more and more, it seems, every decade, or even more frequently than every decade. Taxes currently, well, I'll get to that in just a second, but that's the purpose of depreciation. So we already know that these are the three motivating factors of two types of people. One who want to own investment property, and number two, one that currently own it and want to see more of income, more of appreciation, and more of tax write-offs. So here's the big question. How do I get more for my rentals? See, if you can answer that question, you become very valuable to people who already own investment properties. So I have two questions about investment properties for you, and let's see if you can step up with an answer. Number one, how do you find these people? You see, in 2021, folks, if you aren't making new relationships with people who own one or multiple properties, you're going backwards. You're not maintaining, you're actually going backwards. And instead of people calling you, will eventually stop because of the craziness of the market. And we've been through these cycles before. This is not new. This is just a repeat of a current cycle. The bottom line is the cycle will change. And if you don't know how to get in front of people now, it's going to adversely affect your business. So the big question is, how do you get in front? You find people who own one rental, two, three rentals, five rentals, seven rentals, or even more. Are you ready for the answer? Do you know the answer? It's your title rep. You see, they can give you a farm package of people who own rentals. And if you're looking in particular areas, you'll find who those people are. They'll tell you where they get their mail. They'll also tell you where the property is located. And that's called an absentee owner farm package. Now, if you think about it, on an absentee farm package, you want to ask your title person, number one, do you want condos, or do you want them to give you single family rentals? Want them to give you multiple units like 2 to 4, or do you want 5 and above? Or are there any kind of particular commercial that you're looking for, whether it be warehouse or office buildings, gas stations or car washes, shopping centers? I mean, there's storage facilities. There is a myriad of different use codes that your title person can give you in the commercial end, in the industrial end, and in the residential end. And whichever one you choose to go with, my recommendation is you go with the people who've owned those properties for at least 10 years or longer, because there's equity in those buildings and they stand in the position to raise their monthly income, their appreciation, and their tax write-offs. So let's talk about it. How do you do that? How do I get more from my properties? Okay, let's say each person here, we have what, 10 people on the call, including me. Let's say all of us own 2 properties that we bought at the same time, individually. They're both on the same street and they're both in the same city. So they're very close to each other in proximity, number 2. They're the same square footage, same floor plan, same condition. Everything's the same. There's nothing that's different except for one thing. Property A, we're going to call in brown on your screen, That's got very little debt or no debt. It's very, very high in equity, which is great. It's almost or is paid. Property B has less equity, not as much less equity, more debt. So those are your two properties that you own on the same street in the same city with the same square footage in the same condition, same floor plan. So let's talk about one of those items we just talked about: income, appreciation, and tax write-offs. Number one, we said income is broken into two sections. One is cash flow, the other one is rate of return. So the first question is, which property gets a higher cash flow? The one with almost paid off, or number two, the one with much less equity and more debt? Well, the answer to that is, can anybody guess? The answer is property A. Why? Because there's less debt. You get to keep more. You know who needs to own properties like property A? People who are retired. People who have to have the cash flow, because that's how they're going to live. Because you and I know that a stupid rebate that comes back from the government, stupid Social Security check that comes from the government, is not going to sustain you in Southern California. Cannot live that way. You have to have more income, more cash flow. Second question for income: which property gives you a better rate of return? Property A, who has much more equity, or property B that has less equity? Who can guess that answer? The answer is, beyond a shadow of a doubt, property B. Why is B better for rate of return and A is better in cash flow? Because you see, folks, B is going to collect how much rent compared to A? Almost identical. They're on the same street in the same city with the same square footage, same floor plan, same condition. Do I charge rent based on how much equity I have in a building, or based on what that property can bear in the market in that area? Well, obviously, what it can bear in that area. It has nothing to do with equity. So A has far more equity, but charge more rent, which means the actual rate of for the dollar of equity invested in the property is higher on B, because B has far less equity. You know what A has to do? It has to unload some of the equity, as long as it's not retired, and diversify its equity into another building or two more buildings. So now you have multiple doors paying you rent, not just one. And secondly, when it comes to appreciation, which property will appreciate faster? The answer is, well, they're going to appreciate the same, because appreciation has nothing to do with how much equity you have in the building. So the bottom line is, as we have appreciating markets like we do now and have been for some time, the bottom line is, the more you have, the more goes up. If all the equity is in one property, only one property goes up. So which property will you make more money on in terms of appreciation value in an appreciating market? The answer is, beyond a shadow of a doubt, property B. By the way, remember, you can't raise rent because you have more equity. So the rate of return begins to decline. It's better for cash flow as far as retirement is concerned, but as far as strategy and preparing yourself for those years ahead, rate of return is always the best way to go. Number three, which property will give me better tax write-offs? Is it A or B? The answer is, well, they were both bought at the same time, the same price roughly, in the same street, in the same city, the same floor plan. It's going to have identical depreciation amounts. But the big difference when it comes to depreciation is the tax write-off that you have on the interest that property B pays. See, A doesn't have that. And that gives B a better rate of return, because now it actually gets to keep more of the income because A doesn't have that write-off. Does that make sense? folks, if you're trying to grow a portfolio and you're somewhere in your 20s through your 60s, property B is going to be a better deal for you. But if you are retired and you've got to have the income, then A is a better deal. Does that make sense? So it's called releveraging for growth. And that's what people do. Think about it. They buy a condo, it goes up in value. They sell it, they either buy a single family or they buy a duplex. They hold that for a while, it goes up in value, and then they sell the property, and then they buy a 4-unit or a 5-unit or a 6-unit building. That's how people make money here in the Southland. And it isn't just here, it's other places now that are also appreciating and doing the same thing. So that's the name of the game, and that's how people make money in real estate. So here's the question I'm going to ask you. Of all the people you know who own investment real estate, how many of them are the most wealthy that you know? Chances are pretty good. If they're doing financially well, they probably have investment real estate in their portfolio. So what happens when I go to releverage or I go to, now, whether you're selling your principal residence, your second home or your vacation home, or your rent, the government wants there to tax you. The question is, how do they tax you? Is it based on the amount of equity in the building? The answer is no, it never is. It's based on something called the capital gain. That's why right now, the White House is ready to hand down a tax to Congress to deal with how to charge people who will have something called a capital gain, whether you're selling stocks or bonds or businesses. And can I ask everyone, if
webinar that
you know what?
TPP has every Thursday.
I'm going to mute everybody, and if you'd like to ask me a question, you can just simply unmute yourselves, and then you can definitely come and be a part of it, so we don't have to listen to other conversations going on. I hope that's okay to do.
We got them all muted.
Yeah, you're in. That's cool. Thank you. So let's say I bought a property once upon a time for 300. If you look under number 2 where it says subtracts your adjusted basis, that actually is where it begins, what you paid for the property. But let's say you paid for $100,000 or $300,000 for the property once upon a time. That's number 2A, worth $1 million. So you call up Danny and say, Danny, I want you to sell my property for me, whether it's a principal residence, a second home, a vacation home, excuse me, or a rental. Well, Danny will list and sell your property. He'll give you top dollar, and he'll sell it for $1 million. Congratulations, Danny. It's a nice commission. So what happens is, how will the government tax you? Well, the CPA, you will have to go to your CPA. They're going to look at the $1 million sales price, and they're going to look at what you purchased for, which was $300,000. They're going to add into that $300,000 mark an additional $100,000 because you did a bunch of capital improvements. Now, capital improvements are not repairs, they're not paints, paint and carpet. They're upgrades to the property, like remodeling, expansion to the property, knocking out the windows and putting in new double pane of energy efficient windows, and etc. He's also, if it was a rental, he's going to deduct depreciation out of it because it's been a tax benefit that you've been getting. And then when you go to close the sale, you're going to pay Danny's commissions. You're going to pay Coach House Escrow. You're going to pay a title insurance company. You're going to pay a transfer taxes to either the county for sure, and possibly a city transfer tax, depending on where the property was located. You're going to pay recording fees. That's going to all factor in the difference of the sales price versus the adjusted tax basis. So at the end of the day, when your CPA plugs all these different items into this formula, the difference is the sales price minus whatever the basis adjusted that with the purchase price of the property, that will equal your capital gain, and you will pay taxes on that gain. Now, I'd like to something that I've gotten several calls on over the last few days, and I think it's just kind of weird that people are asking this question. If this is the sale of my principal residence, would I pay taxes on the $600,000 on it? The answer is, well, it depends. If you're married filing a joint return and you've lived in the house for at least the last 2 years, or typically 2 of the last 5 years, the government will give you something called the 121 principal residence exclusion. That means they will exclude up to how much? $500,000 of capital gain off your gain. And since you have a total gain of 100, they will subtract the 500 out of that 600. Does that mean you have to pay tax on $100,000? The answer is yes. Here's the part that people are confused about. Can you do a 1031 exchange on that 100,000? Here's the answer. No way, because it's your principal rental, it's your principal residence. It's not subject to or available for a 1031 exchange because you live there. So you would pay taxes on 100,000. If it was an individual, not a married couple, instead of giving you 500,000 or up to 500, they can give you up to $250,000 capital gain exclusion. That means you'll have to pay taxes on 350,000 because you have a total gain of 600 and they only took off 250. If this is a second home or a vacation home and you have a capital gain of $600,000, what can you do to avoid that tax? The answer is nothing. Or convert that property into a rental, rent it for 2 years, and then do a 1031 exchange. But this is really important. So if you wind up paying taxes on this stuff, the big question is, here's my picture. Let's see if it freezes. And if it does, and it just did, I think I'm going to go back to the old picture that's on there. So if that's the case, then the question is, how much will it cost me in taxes? Well, if your capital gain is $600,000, you'll pay as high as 20% to the IRS. Well, in Washington, the White House is ready to hand down a 10 tax proposal to the Congress for them to vote on. They are talking about between 27 to 39%. What the White House would like to do is eliminate the long-term capital gain to ordinary income. So that would go as high as 39.6%. That is a huge increase. But even if it went to just to 25 or 27%, that's still a significant increase off that $600,000. Number two, you would pay the Medicare tax. That's called the healthcare program. Some people call it the Obamacare. Some call it the Affordable Care or Affordable Health Care Act. Whatever you call it, you have to pay an extra 3.8% into it because as a single person, your gain was over 200,000. And as a married person filing a joint return, your gain was over 250,000. Therefore, you paid the extra 3.8 into the healthcare program. Number three, you have to pay the California state tax. Today, the state tax is generally speaking somewhere between 9.3 to 13.3%. California is the largest, highest tax state in the United States of America. Last year, they tried to raise that tax from 13.3 to 18%. They failed because the legislature couldn't agree. So what happened is they're back to the drawing board and they promised to come up with something because they want more tax revenue for the state. So currently, today is 13.3. And lastly, if it's a rental property, you would pay a 25% depreciation recapture tax. What that basically means is since you had the ability to depreciate the property, the government gave you this tax write-off. You know how it says in the Bible that the Lord gives and the Lord takes away? Well, I guess the IRS read that and the federal government read that and thought they were God. So they decided to give a tax write-off, and now they're taking it away with a 25% recapture depreciation tax. And guess what happens if you don't take advantage of the depreciation? If you're allowed to take the depreciation, you just opt not to take it. You pay the tax on the 25%, whether you got the benefit of it or not, because you were eligible for it and you declined taking it. That's what you pay when you sell a piece of property.
I guess the government always wins because I thought tithing was only 10%, but the IRS is 20, right?
Well put, Danny. Well put. That'd be nice if we just paid 10% to the government.
Yep, 10% would be nice.
Hey, I'll give 10% to the feds and 10% to the state. I'll be okay with that. But here's the deal. In 1921, do you know how many years ago that was? 1921? That was 100 years ago this year. Congress legislated the 1031 tax deferred exchange. And what that basically means is that the 1031 exchange has been here for people who are selling and buying properties, not a principal residence, not a second home or vacation home, but a rental property or investment property or business use property. Purposes of what? Deferring the capital gain. Is it tax-free? Absolutely no way. I wish it was, but it's not. It's not tax-free, it's tax deferred, which means you take your lower basis and your capital gain with you from what we just talked about, from what you're selling into what you're buying. For what reason? To move your properties around into different areas, but more importantly, look in the blue at the bottom, to acquire better income producing properties by releveraging, so you can go from not just higher cash flow, but a higher rate of return that will also produce properties that will appreciate more because now you've got more that's going to go up over time. And ultimately to create more tax write-offs. That's the purpose of the 1031 exchange, is to defer what's on your screen right now. And it's a great, and by the way, currently the White House in their tax proposal has kind of thrown up on a balloon there and hoping that it'll stick. But the balloon is to eliminate the 1031 exchange. This morning, I was on a webinar with the Federation of Exchange Accommodators. We've been working very closely with key congressional leaders and senatorial leaders to make sure this does not pass. Because if it does, it's going to create a slowdown in the real estate economy in the United States. It employs over 250,000 people. When you consider accommodators, realtors who are involved in exchanges, escrow companies, title companies, on and on and on. What happens? Okay, but what about accommodators like me? What happens is that it produces income by virtue of the fact that people are working. They pay taxes to the Treasury Department because you're making money, and they go out and spend money, right? Isn't that what happens? We make money, we pay taxes, we spend money. And when we spend money, we stimulate the economy. And that's why CAR and NAR are backing us up on this one. And they feel that this would be a detriment to the real estate machine. And ultimately, with those kinds of new tax rates, it would also cause something called recession. And this recession would be severe because not only would it slow down all those jobs, but all the other people selling principal residences and having to pay all the capital gains taxes may not sell. And that's a concern to all of us in real estate. Well, I eventually pay the taxes if I do a 1031 exchange or multiple 1031 exchange. Answer, absolutely. If you sell later on and don't exchange. Some people do a 1031 exchange, you've wiped tax. That's just not true. You've just deferred it. However, if you have a trust, as an example, and you pass away and your heirs receive your properties, they don't receive the properties at your original basis or your adjusted basis. They receive properties at a new basis based on the fair market value of the property at the time of passing. Do you know what that means? If I have if I did a number of exchanges or whatnot, and I started off with 300, now my portfolio is worth $3 million, and I pass, it goes to my wife and or our kids if she's not alive at the value of 3 million, whatever the value is at the date of my death. You know what that means? The basis is stepped up. The government has built this in for decades and decades and decades to help people with their families with times of loss and to not put them into tax hardship. And then ultimately, they can sell the property and walk away. Number 3, the White House is recommending to Congress to eliminate the stepped up basis. Do you realize what that's going to do to people, the elderly, who have these reverse mortgages, who are depleting the equity in their property? And then when they pass, it goes to their kids at a much equity, but now there's no stepped up basis. So it's a loser if they keep it, and it's a loser if they sell it, because if they sell it, they may have to come with out-of-pocket money to pay the government taxes. That's why CAR and NAR opposes this like we do. And we're going to continue to fight for our real estate economy in Congress, and hope and pray that the Congress does not pass this White House recommendation. Okay, so what happens when you meet somebody who wants to do a 1031 exchange? Well, first question, or selling rental property, the first question you ask is, why are you selling and what do you plan on doing with the money? So you want to be able to show them that they can defer their capital gains taxes and go into other rentals. Do you know how many people call me each week? I got to put on the video, look at you right in the eye on this one, before my picture freezes. You know how many people call me during the week who want to set up an exchange, but escrow closed yesterday or a week ago? I just don't know why my picture keeps freezing on this, so I'll just stop the video again. But here's the deal. I get that call several times a week. And they said, nobody ever told me. I said, well, didn't you ever call your CPA before you sold? No. Well, why should the realtor be your CPA? They can't. They don't have a license. What about the escrow company? Well, they're not your CPA either. They're not licensed as well. But they're going to blame you, and they're going to blame others because they did something dumb. That's why it's important that you ask the question, why are you selling and what are you planning on doing with the money? And if it's a rental property, they can talk to their CPA, finding out a 1031 exchange is right for them. And then we will set with the escrow officer. In fact, if you turn your eyes to the bottom of the page in purple, it says the exchange must be set up by the facilitator, the accommodator, the qualified intermediary, they call us a bunch of names, before escrow closes. Because once it closes, you have forfeit the right to do an exchange, and the entire gain is taxable. Does that make sense? That's why it's so important. And if you're going to do an exchange, you want to use if you look in the middle where it says zip forms, go to your CAR website, go to the seller's intent to exchange zip form. It's called the SES. It allows the accommodator to be a part of the 1031 exchange, because without us, you have no 1031 exchange. But with us in setting it up with escrow, before escrow closes, allows you to take the next step in pursuing a 1031 exchange. The other reason why I like the SES form a lot, and Danny and Durf, if you're on the phone call, I know you are, Danny, I think Durf might be too.
Yep.
Good, thanks, Durf, welcome. Consider this. The inventory is deplorable. It doesn't exist. It's very hard because you have to find a replacement property no later than 45 days after the sale closes. So what are you going to do if you close the sale and you're having a hard time finding property? So that's why I suggest you use this zip form, this SES zip form, because within the body of the zip form is language that allows you to a contingency to say that if I'm not in escrow on an acquisition, at the close of the sale, I reserve the option to exercise this contingency for 30 more days of extension to allow me to get into escrow, approve a preliminary title report, and to approve a physical inspection on the property. And if I don't achieve it, then I forfeit. I had the extra 30 days, but at least I looked. And if I need it, I can take it and then drop the contingency as soon as I approve the prelim and the inspection, physical inspection report on the new property. That's a good thing to negotiate in this marketplace. The buyer's not going to go anywhere. They can't find anything else to buy either. We're all affected by low inventory. That's why I think that could be good language. And Durf, if you'd like, I can pass some of the language that you could enter into that ZIF form, contingency purposes. Not only do you get the accommodator in, now you negotiate the extension to escrow if needed, because you can't find a replacement property. Does that make sense?
Yeah, if you want to send it over, we can add it to our zip forms booklet, and we'll add in those 2 forms. That way, everybody has a copy of it.
Danny, I'd be happy to do that for you and Durf. Okay, so which properties are eligible? Very quickly, anything that's commercial or residential that generates income. As long as it's property, it generates income, it's eligible for an exchange. What if I don't use it for generating income, but I house it as a warehouse or as an industrial building or an office building, or I have a single family and I'm a state farm agent or a farmer's agent, and I move my business in there and I have my employees in there, and that's where we work out of. Well, it doesn't matter. As long as it's used for business use, it qualifies for a 1031 exchange. Number 3, vacant land qualifies for a 1031 exchange. Again, this has nothing to do with residential, commercial, or even industrial. It's that's used for one of those 3 purposes. Next, what is not eligible? Your primary residence, your second home, your vacation home, a business. None of those are eligible. The only exception is the principal residence in a multi-unit dwelling. So if I have a 3-plex and I live in one of the units, I could exchange the value of the other 2 units and take any one principal residence exclusion on the unit that I live in. So it could be a split use building as far as the exchange is concerned. Remember, the government says it has to be a like-kind property. Like-kind does not mean commercial to commercial or residential to residential. It means the sale of investment real estate into the purchase of investment real estate. So they couldn't care less if you're going from residential to commercial or to vacant land. As long as you go into something like that, the government says you can do a 1031 exchange. Where can I purchase? The answer is anywhere in the US. Last year, our company is one of the largest independents in the country that opens up hundreds of exchanges every month nationally. I oversee California. We even know some other reps. I have a big book of business. 25% of my client base exchanged outside of California last year. It looks like it's going to stay the same this year. A lot of people want out. Did you ever consider talking to people who keep griping about the state, that maybe it's time to exchange their properties and to sell them and do a 1031 exchange and go out of state, where people are flocking to, like Idaho or Nevada, Arizona, Texas, Tennessee, Florida, just to name a few. I mean, there's a mass exodus, folks. Why don't you take advantage of that and start visiting with these people who own multiple properties? 25% of them are going to sell and take, or at least the ones that do sell, are taking the properties out of state. Getting to get to know people and finding out what's important to them, it's what's going to change your business, and it's going to be a help to your client. You'll create new friends just by listening to them and asking the right kinds of questions. For this discussion today, we're going to talk about the delayed exchange. That's something that we've talked about a number of times and over the decades now, I think, that I've been calling on your company. Back in the day when Chuck was running the show, the delayed exchange says you have 180 days to close on whatever you're going to buy based on the day that your sale closes. And that's why you want that contingency language from that zip form in there, because it doesn't start any of these timing, the 45 days or the 180 days will not start until the actual escrow closes. So why not, since you cannot extend the 45 days, there are no COVID extensions anymore. Those expired in the middle of last year. There are no extensions to 180 days. So why not get an extension on your escrow to not start the 45 days as the 180 days? Remember, under the 45-day rule, you can identify up to 3 properties and buy any one of those properties or multiple of those properties, because you're not bound, if you're selling one, to go back into one. You can diversify and go into 2. That's part of the appreciation thing. That's part of the cash flow thing. You can do it however you want. But that list cannot be changed after day 45. Before day 45, you can change it 100 times. Any questions so far? I mean, I've been chatting the whole time, but anything that you'd
I
like
don't
me
see
to
any
add?
in the chat yet.
Yeah, I don't see any chats in the chat room. And I don't hear anybody talking and unmuting themselves. I guess the bottom line, I'll just keep moving until somebody asks me a question. This is the second exchange I want to talk about today. This is a big deal. I'm getting more calls the last year and a half on reverse exchanges than I ever have before. First, let's clear up the misunderstanding. Exactly is the reverse exchange? Many people believe that the reverse exchange is when you open escrow on a purchase first. That is not true. Reverse exchange is when you close a purchase escrow first. When you open escrow, the government doesn't care less. They look at closing to closing. And if you have to close a purchase first because you're to sell in this market, you can't find anything to buy, and you wait till you find what you do want to buy, and you're going to some money, whether you get a loan, like a swing loan or a bridge loan or a line of credit, or whether you have cash to temporarily float for an acquisition, the government will let you close a purchase first through us, the accommodator. We have to set up a holding corporation and exchange documents for the purchase before the purchase closes. And then you close your sale 180 days afterwards. Now, Danny's on the phone, but Durf and the rest of you, I think we should come back in the not so distant future to spend more time with the details because of our time restraints that we have today. This reverse exchange is huge. And you can start communicating that, because I will give you, I've got a number of marketing tools and letters prepared for you. And one of them deals with the reverse exchange on how to find property to buy and close before you close your sale. So you have that proverbial bird in hand as opposed to 3 in the bush. Does that make sense? Next. All the cash from the sale in any kind of 1031 exchange, whether it's a reverse exchange or a delayed exchange, ultimately has to do with the purchase of the new property. On a reverse exchange, you can reimburse yourself after the sale closes because you have to take money out of the bank to float, acquire in a reverse exchange. In this exception, the government will let you keep cash from the sale to reimburse yourself for the money you had to float to acquire your reverse exchange. You can't do that in a delayed exchange because you're not floating money. You close the sale first and then you buy and close within 180 days. So the bottom line, all the cash from the sale has to go into the acquisition. Number two is very important, and many novice investors do not understand this, and we just have to keep clarifying it. If you have debt that you are paying off when you close your sale, the federal government requires in a 1031 exchange to reborrow the same amount of debt or greater based on what was paid off at the close of the sale. You have to have replacement debt when you buy. And that's the bottom line. If you don't accomplish either one of them, pay taxes on that difference. And let me show you what it looks like. Oops. Let's say you sold for, remember our example before? You bought for 300 and you sold for $1 million. Well, now you're selling for $1 million. Did you know that? Well, you know that because you're agents, but your clients have costs, closing costs. It costs money to sell a property. They have to hire you. They have to hire escrow with Coach House. They have to hire a title insurance company. They have for the title. They have to hire a what do you call it? I can't believe I can't, like, what's those reports? NHD reports. Couldn't think of it. You hire, they've got to pay all these fees, transfer taxes, recording fees. If they're doing a 1031 exchange, they have to pay my fees. Let's say the total closing cost for the sale is $70,000. So it's 7%. It's back $930,000 cash from the sale. Now, you know what that $930,000 represents? Your net sale price. Did you know that's what equal or greater is? It's based not on the sales price, but after non-recurring closing costs, that net sales price. That's what equal or greater is. Now, let's say you're selling the property and there was no debt. You walk away with 930, the accommodator, us, holds the money. We put it into the acquisition of the replacement property. Any of the 930 that you keep, that you don't spend for the acquisition of the property, you simply pay taxes on the difference and you still do a 1031 exchange. It's just a partial exchange because you didn't put all the 930 into the acquisition. However, but if you are paying off loans on your property, like what? Well, a first, a second, maybe a lock, maybe a line of credit, whatever it happens to be, those will all be paid off by the title company based on the demands that the escrow company ordered. And let's say the total amount of demands to be paid off is $400,000. That leaves out of your 930 sales price net $530,000 of cash. And that is what we will hold for the client in a 1031 exchange, and to put all that money into the acquisition of the new replacement property of $530,000. If they keep any of the 530, they pay taxes on that, but the rest of their exchange is good. But when they go to buy the replacement property, they're supposed to put all the 530 in, plus they reborrow what was paid off on the sale. How much was paid off on the sale? $400,000. So 530 plus 400 comes up to $930,000. Either way, that's your net acquisition price, $930,000. Now, if you don't want to go through all this with your client, if you sold for $1 million, tell them to buy for $1 million. You'll never go wrong that way, and tell them that they have to put all the cash from the sale into the acquisition. But if you want to slice it as thin as possible, you're replacing cash, 530, number 5. You're replacing number 4, debt, and reborrowing it. And that's how you come up with 930. And if you can't or don't want to borrow 400, you can substitute a loan with new cash. So if I have $300,000 in the bank and I want to put that $300,000 into the purchase of my new property, then I have to only borrow $100,000 because I paid down my debt that I had to replace with new cash from my bank account. Does that make sense? If I want to not borrow anything, I just simply put in $400,000 in new cash. If I put in $200,000 in new cash, now I have to reborrow $200,000. Or I just simply don't reborrow it. I just put in the $200 of new cash. I take the hit on the $200 of debt I didn't and pay taxes on that. So I buy for $730,000. I pay the taxes on the $200,000 of debt I didn't replace, and the government says we're square. Any questions about this? Because I know this can be confusing, but this is so important and so many people get confused with this particular fact. Anybody have a
I don't
question?
see any questions, but normally when people rewatch the video or watch the streaming, I'm sure they're going to call you later on saying that they don't understand it.
No problem. I'm happy to get back with them and let them know. Remember, when you choose an accommodator, make sure they don't commingle your funds. They must put it in a single client trust account. Many of them don't do that for whatever reason. They get a bigger, maybe interest on the flow, something, I don't know, but please make sure you never work with a company that commingles funds. Number two, and make sure, for crying out loud, it is never a corporate account, that the accommodator doesn't put the money in a corporate account of theirs. Because if they go bankrupt, so does your client money. And this has happened several times in the past. Please be careful. No corporate account, no commingling, only a client trust account. And number three, make sure that the accommodator will not release any funds on a verbal, only through a written authorization of your client. And also that the accommodator will call them to say, did you just ask us for an authorization to do something? Could you just clarify that for us, please? We take it to another level, and so should whoever you use. Take it to another level to make sure that isn't somebody impersonating your client's signature or trying to embezzle. Next, make sure they have bonding, errors and omissions insurance, and for crying out loud, make sure they have lawyers on, like we do, that will take difficult questions, work with their CPAs and their tax attorneys or whoever needs to be involved with the transaction. Make sure that they include that in the exchange. I know we're running out of time, so I want to talk about this really quickly. We have a number of questions we ask, like, how do you know how do you get more cash flow out of your properties? How do you measure the cash producing performance of the property you currently have? Most people don't know that. They don't know what the answer is to that. Number two, how do you raise the amount of appreciation on the properties you have? They don't know how to do that either. Number three, is your tax write-off appreciation still effective in your property? And here's the answer: no. Why? Because depreciation is predicated on the value when you first bought, and the CPA will break it down into two sections, into the value of the land versus the value of the building, and the building value is what's depreciable, not the land value. That stays constant over 27 and a half years if it's residential. So the more your rent goes up, the less effective your depreciation is. And that's why releveraging to buy up, to do a 1031 exchange helps. That's why if you want to raise the level of your appreciation, then you don't have all your equity in one building. Remember, we talked about that at the third slide, fourth slide over. To releverage, to have more properties that will go up in value when the market appreciates. That's kind of like saying the rich get richer, but it's the truth. And then later, the cash performance of the property, most people don't even know what that is. One of the marketing pieces that we make available to you is this one. It's how to calculate your rate of return on your current property. The gross income that you make each month, whether it's one or unit building. Number two, you subtract all the annual expenses. Number three, that leaves you the net income off your property. Number four is to find out what the net equity in the building is. And basically you comp it out. You subtract the existing debt on the property, and the difference is your net equity. And then number five, you take the answer to number three, the net income. You divide it by number four, the net equity. And that tells you what your rate of return is in percentage. So it's not what a percentage of interest is. Well, you're looking at a percentage of rate of return off your equity and your income and expenses. You know, most clients of yours or prospects don't know how to do this. And ultimately what happens is this helps them understand what the rate of return is. Get this, folks. I hope you catch this. The higher the equity in the building, the lower the rate of return is. And we talked about that earlier, because you can't raise rent because you have more equity in the building. The return goes down. That's why re-leveraging, buying more, getting a couple more properties in a 1031 exchange helps your client diversify their portfolio and to grow their money. And isn't that why they bought this in the first place? If you would like these letters, you can have them under 2 conditions. Condition number 1, you send me an email to philatwan@gmail.com. I will give those to you under 1 condition. And here's the big condition. You have to promise me that you will use them, because these letters in your inbox or printed on your desk are not going to get in the hands of people until you put them. And these letters and these, like the one I just showed you on the rate of return, how it talks about income, appreciation, and tax write-offs. I've got 16 or 17 of them, different ones. One's in Spanish, the other ones are all in English. But they will help you create new relationships, start the dialogue, and to work with people that you're not working with, or people that are in your farm already who own buildings or multiple duplex, triplexes, or even single family rentals. Folks, you've got to create a relationship with new people. And by doing it, showing them how the 1031 exchange can help them, as long as they can find the right properties, can be a real source of refreshment to their portfolio. I sure hope this was helpful to you today. I apologize for my video not working and freezing constantly, so I'll come on now. I just want to say thank you for doing this today, and don't hesitate to call me or send me an email to request these letters, and it would be my pleasure to provide them. Danny, thanks so much.
Yeah, no problem. Glad to have you, Phil.
Always
If
love
you
to
have any
come in.
questions, feel free to reach out to him. His phone number is right there on the screen, and his email.
Thank you, Phil. Good to see you again.
Yeah, Jerv, all the best. Everyone, have a great night, and we'll see you next time.